Who invented the check? Who built the first bank that could transfer money across continents without moving a single coin? Who looked at supply and demand, division of labor, and the rise and fall of empires, and wrote it all down 3.5 centuries before Adam Smith was born? The answer is not who your textbooks told you, and that absence is not an accident. For nearly 7 centuries, from the deserts of Arabia to the harbors of Malacca, Islamic civilization ran the most sophisticated financial system the world had ever seen. It was not a regional curiosity. It was the engine of the global economy, and almost none of that story made it into the version of history most of us were taught. Dat ens ere. Before Islam, Arabia was a place of remarkable commercial energy and equally remarkable financial cruelty. The Quraysh merchant clans of Mecca had built a regional trading hub, but the economic system beneath it ran on riba interest, so punishing it could reduce a man's entire family into debt bondage across generations. You borrowed to survive, and the debt grew until it owned you. Then, in the 7th century, a single revelation changed the architecture of money itself. The Quran did not merely offer spiritual guidance. It issued economic instructions. The absolute prohibition of riba was not a suggestion. It was structural, a root-level rejection of the idea that money should generate more money without productive work in between. At the same time, zakat, the mandatory redistribution of wealth, was encoded as one of the 5 pillars of the faith. Think about that for a moment. Redistribution was not charity, not optional, not a matter of personal virtue. It was law. The Prophet Muhammad himself regulated the marketplace in Medina, directly standardizing weights, banning deceptive trade, and establishing the Bayt al-Mal, an early state treasury that funded public welfare. This was not economics as philosophy. This was economics as governance, applied in real time to a real society. The rightly guided caliphs who followed formalized what the Prophet had built. Abu Bakr enforced zakat collection even from those who tried to abandon it after the Prophet's death, because he understood that redistribution was the spine of the system, not decoration on top of it. Umar ibn al-Khattab added land taxes and poll taxes, building the first structured fiscal state in Islamic history, with provincial treasuries and interregional transfers that would look familiar to any modern finance minister. This was a state that could raise revenue, move it, and direct it across a territory that stretched from Egypt to Persia. The machine was being built. Then came the Umayyads, and they made it permanent. In 696 CE, the Caliph Abd al-Malik ibn Marwan did something that sounds simple but was seismic. He minted a new coin, the Islamic dinar, stripped of all Byzantine and Persian imagery, stamped instead with Quranic verses. No emperors, no gods, just the word of God and the weight of gold. This was not just a currency reform, it was a declaration of monetary independence. The Islamic dinar and silver dirham became, over the next century, what the dollar is today, the reserve currency of the known world. Merchants from Spain to Central Asia priced their goods in dinars. Even European kingdoms that had never converted to Islam hoarded Islamic coinage because it was trusted everywhere. And then, Baghdad. Imagine the greatest city on earth, not in the Islamic world, but on the entire planet. A city of perhaps 1 million people at a time when London and Paris were small towns of wood and mud. A city built in a perfect circle, the round city of Al-Mansur, with trade as the organizing principle of its design. At the center, the palace and the mosque. Around it, every commercial district you can name. Every guild, every market, every warehouse for goods that had traveled from China, India, East Africa, and the Mediterranean. This was Abbasid Baghdad at its height, the 9th and 10th centuries CE. And in this city, something happened that the textbooks buried. A financial revolution. Consider the merchant who needed to move wealth from Baghdad to Cordoba, 4,000 miles across deserts and seas. He could carry gold. But gold is heavy. Gold is visible. Gold gets stolen. So instead, he walked into a sarraf, a licensed banker, and deposited his funds. He received a saftiya, a letter of credit. He traveled with paper. In Cordoba, another sarraf honored that paper and paid out the equivalent sum. No gold moved. No caravan was robbed. The value transferred on trust, on reputation, on a system of networked financial agents who could be held legally accountable by a Qadi court in any city in the Khalif. This, in the 9th century CE, was the world's first functioning letter of credit. You know what came later? The bill of exchange used by Italian merchants in the 13th century, the foundation stone of European commercial banking. Where did the Italians get it? We will come back to that. The Abbasid financial system was not just one instrument, it was an entire ecosystem. There was the sack, from which the English word check is directly derived. One of the earliest documented checks in history was drawn by a banker in Baghdad in the 10th century and cashed by the Prince of Aleppo. Not in the same city, in a different city. Across distance, on paper, without moving funds. There was Hawala, perhaps the most elegant financial invention in human history. Hawala is derived from the Arabic word for transfer. Think of it as ancient Western Union, except run entirely on reputation and moral obligation instead of corporate infrastructure. A trader in Baghdad tells his broker, "My associate in Cairo needs 500 dinars." The Baghdad broker contacts his Cairo counterpart through a trusted network of hawaladars built over years, even generations. The Cairo broker pays out. No gold crosses the desert. The debt between brokers is settled later, through the natural flow of trade. Hawala worked across 4,000 miles of the medieval world because the network's enforcement mechanism was not contracts or courts alone, it was honor. Defaulting on Hawala meant exile from the system. Ruin. And the system spanned from Morocco to Malacca. Then there was Mudaraba, and this one should stop you cold. Mudaraba is a profit-sharing contract between a capital provider and a working entrepreneur. The investor puts up the funds. The merchant takes the goods, travels the trade routes, sells them. Profit is split according to a pre-agreed ratio. Loss of capital falls on the investor, loss of labor falls on the merchant. No one is guaranteed a return. Risk is shared, not transferred. Sound familiar? It should. The Mudaraba contract traveled through Crusadiera merchant networks in Italian trading houses, where it was adopted almost wholesale as the Commenda contract, the foundational instrument of Venetian and Genoese commerce, and, through that, of early European capitalism. The venture capital deal your startup founder signed this year has DNA that traces back to 8th century Arabia. And the Waqf, the Islamic endowment, deserves a moment of its own. A waqf is a perpetual charitable trust. A wealthy merchant dedicates property, a building, a farm, an entire district to a specific public purpose. In perpetuity, it cannot be sold. It cannot be taxed. It serves its purpose forever. With Waqf, Muslim civilization built mosques, hospitals, schools, wells, caravanserais, the rest stops and hotels of the trade routes, all without a single coin from the state treasury. The modern legal concept of the charitable trust, the non-profit foundation, the endowment that funds universities today, they descend from this instrument. By the 10th and 11th centuries, the Islamic world did not merely participate in global trade. It commanded it. Muslim merchants were the dominant force in the Indian Ocean, the most important trade corridor on earth, connecting China's silk and porcelain to India's spices and cotton, to the ivory and gold of East Africa, to the markets of the Persian Gulf and the Mediterranean. The port cities of this network, Busra, Saraf, Aden, Kilwa, Calicut, were Islamic commercial nodes, administered under Islamic law, financed through Islamic instruments. The dhow, the distinctive Arab sailing vessel, mastered the monsoon winds that European sailors would not understand for centuries. Islamic navigators, with the astrolabe, could calculate latitude, chart stars, and cross open ocean with a precision that made them the undisputed lords of long-distance maritime trade. And where the merchants went, the faith followed. Not at sword point, through commerce. The Muslim merchant communities of the East African coast, of coastal India, of Java and Sumatra, were established by traders who brought not just goods, but contracts, legal frameworks, and a common commercial language that transcended ethnic and national lines. Islamic commercial law was the world's first international trade law. In the West, Cordoba, the Umayyad capital of Al-Andalus, was, by the 10th century, the wealthiest and most sophisticated city in Europe. Not one of the wealthiest, the wealthiest. The annual tax revenue of Umayyad Spain exceeded that of every European kingdom combined at that time. Its libraries held hundreds of thousands of volumes when the largest library in Christian Europe held a few hundred. Christian and Jewish merchants operated freely within Andalusian markets, governed by the same commercial law, integrated into the same trade networks. Across the Mediterranean, Fatimid Cairo served as the other great financial crossroads, and the Cairo-Geniza documents, a remarkable archive of actual medieval merchant correspondence discovered in a Cairo synagogue, give us an extraordinary window into how it all worked. Jewish, Muslim, and Christian merchants writing letters to each other about shipments, credit, losses, partnerships. A pluralist commercial civilization documented in ink on paper, buried in a synagogue, discovered centuries later, and largely ignored by the textbooks. Now we arrive at a man who deserves more credit than almost any thinker in economic history. Ibn Khaldun. Born in Tunis in 1332, he lived through plague, political chaos, and the collapse of dynasties. He retired to a desert fortress in what is now Algeria, and in the isolation of that place, he wrote the Muqaddimah, an introduction to his planned universal history that became, by accident, the first systematic work of economic and social science the world had ever seen. Ibn Khaldun wrote about supply and demand. He wrote about division of labor and how specialization drives prosperity. He wrote about the role of government spending in stimulating economic activity, ideas that Keynes would rediscover 600 years later, and he wrote about taxation with a clarity that staggers the mind. He argued, in 1377 CE, that low tax rates produce more total revenue than high ones, because low rates encourage economic activity while high rates strangle it. He showed how dynasties begin lean and disciplined, impose modest taxes, generate wealth and loyalty, then grow fat, raise taxes, suppress activity, lose revenue, and eventually collapse. In the 1980s, Ronald Reagan quoted Ibn Khaldun from the Oval Office to justify supply-side economic policy. Arthur Laffer, the economist who drew the famous Laffer curve, has acknowledged that Ibn Khaldun preceded him by 6 centuries. The founding idea of modern fiscal conservatism was written by a medieval North African Muslim scholar in a desert fortress. How many economics courses teach that? And then there was Mansa Musa, Emperor of Moli, ruler of the wealthiest state on earth, commanding the trans-Saharan gold and salt trade that supplied Europe and the Middle East with the precious metal their economies depended upon. In 1324, Mansa Musa departed his capital for the Hajj to Mecca. He traveled with 60,000 people. He brought 80 camels, each carrying more than 100 pounds of gold dust. Gave it Hawaii. In Cairo, in Medina, in Mecca, he distributed gold so lavishly that the Egyptian historian, writing 12 years after the event, found Cairo's inhabitants still feeling the effects. Musa had flooded the market with so much gold that its value collapsed. Prices across the Middle East inflated. The gold market took more than a decade to stabilize. One man went on a pilgrimage and accidentally triggered the first documented case of monetary inflation caused by a supply shock in recorded economic history. That is the scale we are talking about. Back in the Caliphate's heartland, the financial system was held together by institutions as sophisticated as the instruments themselves. The Hizbah was the world's first formal market regulatory body. The Mutasib, the market inspector, walked the bazaars with authority to enforce honest weights, prevent monopolies, stop price gouging, and punish fraud. This was not informal social pressure. This was codified in detailed manuals like Al-Shazari's 12th century Nihayat al-Rutbah that read, in their precision and scope, like modern consumer protection legislation, medieval Europe had no equivalent, and beneath the Hizbah, the architecture of Islamic commercial law, fiqh governed every transaction. The 4 major madhabs, Hanafi, Maliki, Hanbali, each developed distinct but overlapping bodies of commercial jurisprudence. The Hanafi school dominated the commercial centers of Iraq and Central Asia. The Maliki school governed trade law across North and West Africa. The Shafi school was the legal backbone of Indian Ocean commerce. A merchant from Busra, trading in Calicut with a Moroccan partner, was doing business under a common legal framework, one enforced by Qadi courts that recognized contracts across borders, across ethnicities, across religions. This was international commercial law. 7 centuries before the world got around to inventing the concept officially. And then, the rupture. February 13th, 1258. Hulagu Khan, grandson of Genghis Khan, led his army into Baghdad. What followed was not conquest. It was erasure. In 10 days, a city that had been the financial and intellectual capital of the world for 5 centuries was reduced to rubble and ash. The House of Wisdom, the greatest library and research institution in the medieval world, was destroyed. The canals that fed Baghdad's agricultural hinterland were deliberately cut and left to silt. Without water, the fields died. Without fields, the population collapsed and never returned. Historians estimate that the Mongols killed hundreds of thousands in Baghdad alone. The numbers are still debated, but no one disputes the devastation. The last Abbasid caliph was wrapped in a carpet and trampled by horses because Mongol tradition held that royal blood must not touch the ground. The caliphate, the institution that had unified Islamic economic life for 5 centuries, was gone. A generation of accumulated financial knowledge, infrastructure, and institutional capacity destroyed. And while the Islamic world was still absorbing that blow, a second one came from a different direction. In 1498, the Portuguese navigator Vasco da Gama rounded the Cape of Good Hope and reached India by sea. What this meant, in economic terms, was brutal and direct. Muslim merchants had been the indispensable intermediaries between Asian producers and European consumers for centuries. They owned the corridors, they set the prices, they held the leverage. Da Gama's route, sailing around Africa, bypassed all of it. Within decades, Portuguese and then Dutch and English fleets were trading directly with Asia. The Islamic middleman was cut out of the chain. The Indian Ocean, which had been an Islamic lake for 7 centuries, became contested and then dominated by European naval power. The trade revenues that had funded Abbasid libraries and Fatimid palaces and Andalusian universities flowed instead into Lisbon, Amsterdam, and London, and from Terre into the capital markets that would fund the European colonial project. The financial infrastructure that Islamic civilization had built became the foundation on which European economic dominance was constructed. Europe did not invent its way to supremacy. In significant part, it borrowed and then cut off the source. Consider, the Italian commenda was the bill of exchange was the Leonardo Fibonacci, whose 1202 Liber Abazi brought mathematical revolution to European commerce, explicitly acknowledged Arabic and Islamic mathematical sources. The Arabic numerals that made double-entry bookkeeping possible, that made accounting scalable, that made financial capitalism computable, came to Europe through Islamic Spain and Sicily. Al-Khwarizmi's algebra, the mathematical structure of modern finance, is named after him. The word algorithm is a Latinization of his name. The word algebra comes from his book. Every spreadsheet, every model, every quantitative financial instrument ever built stands on this foundation, and then it was repackaged. The origin quietly forgotten. But history does not stay buried forever. In 1963, in the Egyptian delta town of Imti Gamr, an economist named Ahmad al-Najjar opened the doors of a small savings institution. No interest paid, no interest charged. Profit-sharing accounts, investment in local business. It was an experiment, modest, almost obscure, but it was the first institutional attempt in the modern world to rebuild the financial architecture that the Quran had specified 14 centuries earlier. The MIT Gamr Bank lasted only 4 years before political pressure shut it down. But the idea survived. By 1975, the Islamic Development Bank was established. The Dubai Islamic Bank opened. The Al Rajhi Bank in Saudi Arabia grew to become one of the largest financial institutions in the world by assets. Today, the global Islamic finance industry manages more than $3 trillion in assets, larger than the GDP of France. Sukuk, Islamic bonds, structured around asset ownership rather than interest, have been issued by sovereign governments from Malaysia to the United Kingdom. Tekuful, Islamic insurance, built on mutual contribution rather than premium for profit, serves millions of policyholders across Southeast Asia, the Gulf, and sub-Saharan Africa. And yet, the most serious challenge facing modern Islamic finance is not size. It is identity. Critics, including scholars within the tradition, have pointed to instruments like where a sequence of transactions is designed to produce what is, in economic substance, an interest-bearing loan wearing Islamic clothing. Is this genuine innovation or elaborate camouflage? The debate is live, intense, and unresolved, and the answer matters enormously, because if modern Islamic finance is simply conventional banking wearing a different label, then the entire civilizational legacy this video has traced becomes merely a marketing strategy. That would be a tragedy, far quieter than the Mongols, but no less real. What this civilization built at Hitsedi was a financial system with ethics baked into its structure, not bolted on as afterthought. Risk-sharing instead of risk-dumping. Finance tied to real productive activity rather than abstraction stacked on abstraction. Redistribution, zakat, waqf, sadaqah as mandatory features of the system, not optional charity. A market regulator with actual teeth. Courts that enforce contracts across borders and across faiths. And a body of theory, Ibn Khaldun's theory, that understood, with startling clarity, how prosperity rises, how greed corrupts it, and how the same cycle repeats. He wrote it all down in a desert fortress in 1377. We are still watching the cycle play out. The question that should sit with you after this, the question that does not resolve cleanly, is this. A civilization that once ran the world's finances on principles of shared risk and ethical constraint was dismantled, its instruments borrowed without credit, its trade routes severed, its institutions colonized. The financial system that replaced it is the one we all live inside now. And in that system, risk flows downward to the many, while reward flows upward to the few. Ibn Khaldun saw it clearly. The early caliphs built the alternative. It worked for centuries. The question of whether it can be rebuilt, honestly and not just nominally, is not a question from the past. It is the most urgent financial question of this century.